On behalf of Marmore, we welcome all the participants to the Marmore webinar series. Marmore is a majority-owned subsidiary of Kuwait Financial Center Markers. Established in 2010, Marmore has developed full-fledged research capabilities covering multiple research domains such as infrastructure research, economic research, capital market studies, policy analysis. Marmore is currently focused on serving the interdisciplinary knowledge needs of its client and stakeholders. In today's session, we'll be discussing about the GCC economic themes and market outlook for its capital markets such as equity and debt for 2018. Questions, if any, could be asked at any time during the course of the webinar, and it shall be addressed at the end of the presentation. Recording of the webinar presentation will be sent in a day or two, and the same will be uploaded in the Marmore website and YouTube channel as well. Questions, if any, can also be mailed to the email ID that will be flashed at the end of the presentation. I'm joined by my fellow speaker, Mr. Irfan, who will be dealing with the capital market outlook. Right now, we'll begin with the first part of the presentation, GCC economic themes. We list out 4 key pillars as part of GCC economic themes in 2018. The first pillar would be the change in the government expenditure stance, which prior to 2018 had been austerity because of low oil prices. But currently, in the recent budgetary documents, we have seen that the expenditure has been increasing and the governments have embraced expansionary fiscal stance. We also notice a lot of reforms that are happening across sectors, but the most notable is the one which is happening in the GCC markets, as a result of which we see certain markets being upgraded by the FTSE indices. MSCI index has also viewed favorably the ongoing reforms, and certain markets have been upgraded to the watch list for subsequent upgradation into the MSCI EM indices, possibly in 2018 or at max by 2019. As a special section, we also discuss about the ongoings that are happening in infrastructure space. And finally, we conclude with the vibrant activity that's happening in the sovereign debt market space as part of GCC economic themes. In the subsequent slide, we'll discuss each one of this pillar in depth. The first theme, governments embracing the expansionary fiscal stance, is the key theme for us. In the recently released budgetary documents of Saudi Arabia, Kuwait, Qatar, and UAE, this is one major theme which we are witnessing. In 2014, after the collapse of oil prices, the oil prices fell from 3 digits to sub $50 per barrel. This resulted in widespread deficits, and the balance sheets of the governments for the first time had to face a lot of funding shortfalls due to lowering of revenues from the hydrocarbon side. To tackle this, the governments had to resort to austerity measures. A lot of spending was curbed, and this started having an impact on the overall economic growth. But currently, we see the balance sheets have been consolidated, and with the recovery of oil prices in late 2019, the governments have been quite optimistic because of the better compliance by the OPEC members and non-OPEC members to sustain oil prices above $65 per barrel. And this confidence has led the GCC governments to embrace the expansionary fiscal stance, a shift away from the past 3 years of budget financing. We see Saudi Arabia leading the pack with the expenditures amounting to almost USD $260 billion in 2018. Kuwait, Qatar, and UAE, Emirates of United Arab, have also embraced a similar structure, wherein they are willing to expand their balance sheets to revive the economic growth. This we see it as a very critical in order to revive investments and support the economic growth, which had been falling due to the weakness in the hydrocarbon sector. This we believe will be a major theme which we need to continuously watch out for based on the government spending needs. And this we also believe would revive the sagging growth in the economy and increase the investments and the overall jobs and etc. The second important theme is the reforms which are happening in the capital market sector. Post 2014, a lot of reforms began to take place across sectors. We saw reforms in the form of removal of subsidies. We saw reforms to increase the non-oil revenues with the introduction of taxes and VAT. But the most prominent place where these reforms had some sort of action in the ground was in the capital markets. They again in the capital markets, across the markets, reforms were enacted. The most prominent ones happened in Saudi Arabia and Kuwait. The initial reform space, which was started by UAE and Qatar, led their markets to be upgraded by MSCI from Frontier Market Index to EM Market Index. The move was welcomed by most investors. It saw inflow of good money. The companies began to reap the benefits of being listed in MSCI EM Index. The governance, the transparency, everything improved. So following the footsteps of UAE and Qatar, its peer countries such as Saudi Arabia and Kuwait also began to add a new renewed momentum to implement reforms in the capital market space. With this is all the more crucial for Saudi Arabia with the Saudi Aramco IPO being lined up. We saw a lot of reforms happening in KSA, the primary one being the introduction of short selling, which before was banned. And we also saw the settlement cycle being moved to T+2 cycle, as in like the trade, after the trade, the settlement will happen in T+2 days. This synchronized Saudi settlement cycle with the global markets. In addition, Saudi has been very prominent by publishing a lot of white papers, and it also relaxed the norms for institutional investors to attract more investors and to boost up the liquidity. I mean, all those reform efforts have been taken cognizant by index players such as MSCI and FTSE. Though FTSE upgraded only Kuwait in this EM, it has acknowledged the reform efforts of KSA. And MSCI Morgan Stanley Capital Markets Index has acknowledged the reform momentum which is ongoing in KSA, and it has included KSA indices in its current watch list. And it's widely expected by the market for KSA to be directly included in the MSCI EM market index, either in 2018 or in 2019, which will be a big boost for the GCC region as a whole. With regard to Kuwait, with the initiation of a new chairman, CMA has been very active in transforming the Bursa Kuwait. Steps are also being taken to privatize the exchange. Tenders are being floated, and as a positive sign of all the reforms which are taking place, Kuwait market was upgraded by FTSE index into this EM, which is estimated to bring an inflow of $450 to $700 million. Additionally, they are striving for to increase the liquidity in the exchange by bringing market makers, by increasing the analyst coverage of stocks, in order to pay way for subsequent inclusion into the MSCI index in line with its peers such as UAE and Qatar. As a third theme, we'll dig a bit deeper into the GCC infrastructure. GCC infrastructure is one of the prominent sector which has a lot of visibility because of the high value of project spends that keep happening. If you see in the chart which we have displayed, which talks about the value of project awards, the value of project awards peaked in 2018 in the past 10 years, with the amount of projects being awarded stood at $275 billion. And over time, following the financial crisis, it witnessed a slump. And once a recovery was happening, it again peaked up. But currently, due to the fall in oil prices, it again started slumping. And the amount of projects which typically stood near $300 billion in 2018 currently stand less than 1/6 of the value at around just $50 billion. And this can ideally, they capture the essence of what essentially is happening in the physical front and with the government balance sheets. It's not just that the market field for the infrastructure players has reduced. Due to the low oil price, the governments began scrapping a lot of non-priority projects. A lot of pet projects also was being put on hold. Only key projects that are required to sustain the economic growth were given priority. The government, due to the impact on the balance sheets, also started delaying the payment to contractors. This really squeezed the contractor, working capital cycle and the margins. With the playing field being already dwindled to 1/6 of the size, the contractors began to compete for the few available projects. They thought, it would be sufficient even to bid for projects just to cover their overheads, and this led to deterioration of operating margins themselves. Indeed, many of the contractors still continue to post operational losses. The working capital cycle continues to be elongated. Though the governments have showed up their finances now, in the ground situation, a lot of things needs to change, especially with regard to awarding of projects. We also expect the awarding of projects to have reached its bottom and to go only up from here, because of two reasons. One, the Vision 2030 of Saudi Arabia, which entails massive amounts of investments in infrastructure, and two, Dubai Expo is happening in 2020. A lot of projects needs to go on for efficient functioning of it. And three, Qatar would be hosting the FIFA World Cup. A lot of work still needs to be done. And four, Kuwait is also pumping up its investments in infrastructure space, as it has always lagged behind the GCC peers, and this is the time to really pick up in order to be competitive along with the GCC peers. So this is something which is happening in the GCC infrastructure space. I'd be happy to take more questions on GCC infrastructure at the end of the presentation. And theme 4 would be the activity which is happening in the sovereign debt. Over here, we cover only the international issuances by the GCC sovereigns. And it being the norm, Saudi Arabia has again is leading the pack with almost $12 billion of issuances in 2017. Significantly, Qatar is absent from the international issuances in 2017. In 2017, put together, all the GCC governments raised approximately $37 billion. And despite this being the amount for each and every issuance, they were subscribed like 4 times and 3 times or 5 times the value of the bond offering, which signifies the enough healthy interest in the international markets for GCC bonds. We'll be seeing more about the sovereign debt market and the capital market section. So for the time being, I'll just hand over the presentation to Irfan, who will be dealing with the equity markets. Post the equity markets, we'll be discussing the debt markets.
Thank you, Rajesh. Like Rajesh pointed out, I'll be discussing the equity market outlook for all the GCC countries and the outlook for the year 2018. But before we could look into the outlook as to what we forecast, how the market would be in 2018, I would like to first take you through as to what our predictions were for the market in 2017 and how the markets performed in respect to our predictions. So in this slide we have discussed the outlook that we had expected for 2017, and most of the markets were in line with our expectations. Saudi and UAE, to be more precise. However, Kuwait and Qatar were not in line. They were the outliners. Qatar, we did expect a negative performance from the Qatari market simply because of the at the beginning of 2017, we felt the Qatari market was overvalued and it was not capturing the actual the market. The equities were priced high at a premium, so we did expect a negative performance by the Qatari market. But the severity of the underperformance was something that shocked us. And the severity is simply due to the ongoing Qatar embargo that resulted in Qatar market underperforming significantly. As far as Kuwait is concerned, Kuwait was the only contrarian to our earlier forecast. We did expect Kuwait to perform on neutral basis. However, several factors such as Kuwait's inclusion in the emerging market index and the expectation of Kuwait's inclusion in the emerging market index throughout the year supported Kuwait markets rally in 2017. And also most of its rally came from the first quarter of 2017, which helped Kuwait to sustain its subsequent losses in the subsequent 3 quarters. Now looking at the now 2018 outlook for the equity markets, we have used a four-force framework for stock market to assess or to identify the outlook, predict the outlook for the stock market. The 4 matrices based on which we evaluate each markets are valuation, attraction, market liquidity, economic factors, and earnings potential. And we have also highlighted the different weightages that we give to all these factors. In economic factors, we assess based on GDP growth, inflation, fiscal, and current account balance and debt. And we assess each of the markets in this based on these matrices to evaluate and give out the outlook for the 2018. To start with the GDP, 2017, the OPEC-related production cuts had weighed very heavily on the GCC hydrocarbon sector, and hence it also affected the non-hydrocarbon sector. It's the sentiment in the non-hydrocarbon sector, and it was a common phenomenon that was observed across GCC markets. However, with the prices stabilizing to some extent in 2017 and also expected to be at a given the OPEC production cut agreement, which is expected to last till September 2018, we feel this would actually support some momentum in the non-hydrocarbon sector and also help the hydrocarbon sector to stabilize and thus supporting the equity markets in the region. Apart from that, all the governments in the most of the governments, for that matter, in GCC have adopted on an expansionary budget policy for 2018, as highlighted or discussed in the themes by Rajesh. And this is also going to support the economic growth in the regional markets. And for example, Kuwait, the government plans to invest close to about $115 billion in oil sector over the next 5 years. And also Qatar, although the growth is expected to be subdued due to ongoing diplomatic crisis, it's still expected to spend close to about 130 billion in infrastructure just before the FIFA World Cup. And these investments should support the economies to economic growth and also be able to offset the headwinds resulting in Qatar due to the ongoing crisis. Now, the second factor is inflation. The fiscal consolidation and subsidy rationalization stand adopted by the governments in 2017 somewhere it affected the investor confidence and in consumer sentiment, and also helped the governments keep the inflation in check throughout 2017. But things look a bit different in 2018 with the introduction of VAT in some countries, and also some countries like Saudi, which recently increased the domestic energy prices. We expect inflation to be affecting the regional markets, inflation to have some impact on the performance of the equity market, regional equity markets. And additionally, introduction of VAT, especially in UAE and Saudi since the beginning of the year, and with that cost at almost 5% to the cost of most goods and services in the range of sectors, including real estate, retail, industry, and financial services. Though initially this was VAT was expected to have an impact, inflationary impact in Qatar as well. Now that Qatar has deferred the implementation of VAT till 2019, this is for time being, this will not have any impact on the Qatari equities. In the next metric is which is still part of economic assessment is fiscal and current account balance. Now, like Rajesh highlighted, most of the countries adopted a very underwent fiscal consolidation efforts and throughout 2017, and they have actually begun to bear the fruit, and the fiscal deficit is projected to be narrow in 2018. In case of Saudi Arabia, the fiscal balance program introduced in 2016 is expected to be implemented as per planned schedule, thus contributing to a further consolidation. Qatar too adopted a very prudent approach in terms of budget planning and for 2018, and which is expected to increase marginally by 2.4% year on year. And this should support Qatar from avoiding any fiscal slippage resulting in need for excess or excessive debt burden to support its expenditure. As far as UAE is concerned, electricity and water tariffs were increased from all the consolidation efforts kicked in 2015, and since then the electricity and water fuel tariffs were increased and fuel subsidies were removed. This support Kuwait this supported Kuwait in keeping its fiscal balance in check, and this should subsequently be able to in 2018 be able to support this government to go on expansionary budget, and this should ultimately translate into earnings potential or earnings opportunity for the UAE market as well. As far as the current account balances are concerned, Saudi's current account balance was expected to be a small surplus in 2017 as oil export revenues increased and import growth and remittance outflows remained subtle. Although public employee allowances were reinstated in April 27, other measures introduced in 2016 to rationalize wage bill remain in place. Now, in case of UAE, the current account surplus to be 2.1 of GDP during 2018 as oil revenue rise with increased oil production, which is also complemented by exports and tourism. And in terms of Kuwait's current account balance, which was historically highest among all GCC nations between 2009 and 14, is expected to be run into a deficit in 2018. This is because Kuwait is likely to this is due to the robust import growth due to rising capital goods imports to support the demand related to government infrastructure projects. This is expected to exert pressure on the Kuwait's trade balance. The other economic factor is the debt. As we can see, historically, all the GCC markets have had very low levels of debt, with exceptions being Bahrain and Oman. However, now most of these countries have resorted to a combination of external borrowing and drawdown from reserves to plug their fiscal and current account deficits. In 2017, GCC countries accessed both domestic and international markets to finance their budget for shortfalls. In 2018, we expect a lot of GCC markets to return to debt markets to plug their deficit. And Saudi, we are expecting the debt to GDP ratio to reach 20.8 as a recovery in oil price, introduction of VAT, and further austerity measures and forecasted gradual increase in global energy prices should cap the debt to ratio at around 25% in the medium term. Kuwait too opted to rely on the debt to finance its deficit, and it made its mega issuance worth 8 billion in 2017. However, is expected to incur financing needs of Kuwait is expected to incur a financing needs of close to about 100 billion in the next 5 years. Aggregate of 100 billion in next 5 years, and this is more likely to be met by both domestic and international borrowing. So based on these economic factors, we have on all the economic factors discussed, we have a neutral outlook for most of the GCC markets and negative outlook for Oman, Bahrain, and Saudi. In terms of earnings potential on an aggregate, we expect the earnings growth to be moderate at 5% in 2018 for all the GCC markets combined. And this is simply because of the GCC governments which have embarked on the expansion mode post 2 consecutive years of fiscal consolidation and several austerity measures. And further, now that the liquidity, in terms of sector-wise earnings, we expect the outlook for the GCC banks remains stable for 2018. With the liquidity pressure, which was eased by injection of funds by the GCC governments in 2017. And moreover, factors like infrastructure-related projects like UAE Expo 2020, World Cup 22, and Saudi National Program This will support capital spending by the governments and hence facilitate credit growth in these countries in 2018 and contributing to better performance of the banking sector. The construction sectors also are likely to contribute significantly to in terms of earnings in the GCC markets. Again, the performance of construction sector would be due to the ongoing projects and mega events that are coming up. And commodities prices also, the recovery of oil price in 2017 and stable price in 2018 is expected to have a turnaround effect on the commodities sector across GCC countries. But the drop in earnings for Qatar, despite oil price recovery, can be attributed to weaker activity and sentiment in the non-hydrocarbon, reflecting a diplomatic and trade ties, reflecting the severing of diplomatic and trade ties by the several Arab nations. In terms of valuation, we have positive outlook for Oman. We feel Oman is relatively at the right valuation compared to its regional peers. Saudi, we have a negative stand because when we initially drafted this outlook or came up with this assessment, the Saudi's purge was not captured in the valuation of the GCC equity market, which was supported by significant buying from the domestic institutional investors. So we felt the Saudi market was overvalued or hated due to not being capturing the actual investor sentiment on the ground. In terms of the market liquidity, we have neutral stand and we have negative stand for all the GCC markets. The market liquidity has been on a drop since 2000. Since the peak in 2014. In 2017, the turnover ratio was close to about GCC stock markets had some of the lowest levels of liquidity in 2017, clocking in a turnover ratio of 29%, despite the emerging market status for Qatar, UAE since 2014, and also Kuwait's graduation in 2017. However, Kuwait alone was the only outliner which witnessed a 90% increase in the value traded in 2017, and we expect that momentum to continue but to some extent in 2018 as well for Kuwait, with Kuwait being classified as an emerging market by FTSE. And going forward for Saudi also, we might have some recovery in the turnover or liquidity as we are expecting Saudi also to be classified as an emerging market in the year 2018 by MSCI. So this brings us, based on this assessment, this brings us to the overall outlook for 2018 for the GCC markets. So we are neutral on most of the markets, though the markets are supported by fiscal expansionary budget plans for in most of these markets. I feel they are starting from a lower base and things are just stabilizing. So we do not have very positive outlook for any of these markets. And hence, we have maintained a neutral outlook. Qatar, we have maintained a negative outlook simply because that despite the exorbitant expenditure or spending related to infrastructure, the Qatar's economic growth is expected to be slowed down unless the crisis comes to an end, and that will have a negative impact on the overall performance of the Qatar equity markets. And Bahrain, we have Bahrain is also, we maintain a negative outlook simply because of its high levels of debt and struggling economy, and also which will ultimately have a lower earnings potential for the stocks in a Bahrain market. Now I'll be discussing the two themes that have been dominant throughout 2017, two equity markets related themes that have been dominant throughout 2017. The first one would be Kuwait's upgrade test to FTSE Emerging Market Index. In its annual classification review of FTSE for 2017, FTSE decided to include Kuwait in its secondary emerging market category for 2018. Now that this increases the tally of GCC countries to 3 under emerging market status. Saudi, however, unfortunately could not make it to the emerging market list by FTSE, and however it's still on the watch list. And how Kuwait, the several proactive measures taken by Kuwait in such as improving its trade settlement and custodial and boosting market liquidity yielded result, Kuwait being upgraded to emerging market status. This the inclusion of Kuwait index is expected to bring estimated inflow of close to about 450 to 700 million in Kuwait, and Kuwait is expected to have weightage of 0.5% in FTSE emerging market plus China A all cap index. In terms of what it means is that Kuwait would be part of MSCI emerging market FTSE emerging markets index, and close to about USD 1.5 trillion passive funds are actually benchmarked to the emerging market indexes, which as against 15 billion, which are benchmarked to the MSCI Frontier Markets Index, which Kuwait was part of until recently. However, inclusion of Kuwait in FTSE secondary market is a welcome development, and they must follow the route of UAE and Qatar to get listed in the MSCI emerging index market as well. The second dominant theme would be the question that has been prevailing throughout 2017 and would be actually on the minds of the investors in 2018 as well, would be if MSCI would manage to get an upgrade. Now, Saudi would manage to get an MSCI upgrade and get included in the emerging market index. Saudi, in order to to achieve this, has incorporated several capital market reforms. Like Saudi plans to make its capital market more accessible to foreign investors by offering them full access to the secondary or parallel market called NOMU. And Saudi also embarked on introducing short selling in 2017 so that it can attract and also secondary equity market for smaller family-run firms, which aims to improve companies' access to capital. And in order to attract more foreign investors, Saudi also, which in 2015 permitted foreign qualified institutional investors to participate in the Saudi market. To increase the investor base is also relax the minimum norms that have to be met by the investors to qualify as an institutional investor. Earlier, the cap at the asset under management was set at 1 billion. Now that has been reduced to 500 million. So this would enable actually more of qualified institutional investors to be part of to take part in the Saudi equity markets. So these are the two dominant themes that related to equity market. Now I'll hand over the discussion. Now my colleague Rajesh would take over the discussion, and he'll again discuss the debt market outlook for 28.
Thank you for the insightful session on GCC equity market outlook, Irfan. We can now discuss or oversee the debt market on its outlook into 2018. GCC debt market, which were in a very nascent stage prior to the fall of oil prices, witnessed a significant boom in the recent years. Especially in the international market, and the GCC governments have been very active in raising sovereign issues. Some of the countries like Saudi Arabia, Kuwait, Qatar, which prior to 2014 weren't a big participants or active participants in the international market, came with a lot of issues, which was well received by the investors, especially from the Asian market. Again, the GCC governments had a Goldilocks kind of movement, wherein the issues were supported by ultra low interest rates in the monetary system at the global level. Plus, there was a huge appetite among the investors for positive yields. Additionally, GCC governments, their balance sheets were attractive in their own way. They had very low levels of debt as characterized by debt to GDP. Their ratings were on par with that of developed nations and much higher than the emerging market peers. And they were backed by sufficient foreign reserves, which made their debt issues are very attractive to the yield-hungry institutional investors in the global market. As a result, you can see most of the GCC countries were able to raise a significant amount of debt at attractive spreads or very tight spreads in bond language terminology. Saudi Arabia was the leader of the pack, raising 12.5 billion in 2017, and it raised, despite being A minus, it was able to raise debt at maybe 100 bips premium to US Treasury bond. Bahrain, despite being junk rated by the rating agency, was able to raise more than 2 billion in the international markets, but as a sizable spread. Coming to the local domestic market, GCC corporates were active players. GCC corporate players who have been relying on bank debt for a long period of time woke up to the opportunity offered by the debt markets in the domestic financial systems. Banks, they were affected by the low oil prices too. Deposits, inflow of deposits began to weaken, and most of the sovereign issues by the GCC countries were again lapped by the banks. This created a sort of liquidity squeeze in mid 2016, wherein we saw the interbank rates rising. Banks which were preparing themselves for the upcoming Basel III norms began to, judiciously use capital. So they began to finance projects on a very selective and priority basis. So most of the corporate starved of funds began to tap the domestic bond system. And if you see in 2017, the amount of domestic bond issuance had almost doubled. In 2016, they raised approximately 20 billion USD worth of money, while in 2017, the same amount stood at $35 billion. So we can see a lot of activity happening, and corporates are utilizing the low interest rates judiciously by raising capital at a much lower cost. An interesting trend which we began to observe is in most of the GCC countries, the government-related entities began to explore a variety of bond offering. For example, for projects, a lot of project bonds was being discussed, and some of the projects themselves they floated a SPV and started raising bonds. Currently, UAE is the preferred destination for fundraising because of the legal framework and regulatory framework they have, and the attractiveness which they offer to the international investors as well as the domestic investors is unparalleled when compared with any other GCC country. And going ahead, we believe a lot of corporates would continue to tap the domestic corporate bond or the domestic debt market. With the UAE, we believe could lead the pack. Another interesting development in the debt market is the formation of debt management offices in GCC, which we appropriately considered it to be a great and a giant institutional step for all the GCC countries, which has been lacking in quality institutions apart from the central banks which they currently have. This debt management offices fall under the Ministry of Finance, and they primarily perform the treasury role, which before was performed by the central bank. With the US set to hike their rates in the coming monetary monetary policy discussions, we already witnessed 3 rate hikes in 2017, and even in 2018, the outlook remains more or less the same. And the central banks have a hard time, coordinating the monetary policy, apart from ensuring that the peg stays strong, and they have a variety of other functions in ensuring that the growth is revived, inflation is contained. So it would be an additional burden for them to manage the sovereign issues as well. Maybe if 1 or 2 issues are going to happen, they could take on the load. But with sizable activity happening in 2017 and even with 2018, the outlook being the same, it's time they remove the functions into a separate institution. Such as debt management offices. Most of the GCC countries have moved ahead and established their DMO as a separate arm of, Ministry of Finance. Saudi Arabia, Dubai, Kuwait, all now their own debt management officers. The primary role of the debt management officers is to ensure debt is being issued on a regular time manner across tenures and in sizable quantity, to perform road shows, to attract investors and broad base the investor for all this debt, so that it reaches to a wide amount of people. And it also helps in establishing the yield curve once debt is issued across maturities. Having a separate department also helps in ensuring the government liabilities are met, and it ideally helps to draw down a timetable of when exactly the government would be needing money, how it's going to raise the money for the same, at what maturity should they release it. And apart from it, it will also act as more like an investor relation center for a corporate. It will be able to address most of the investor queries pertaining to the debt details. So any investor, in case if they have subscribed to the government bonds, the DMOs will act as a one-stop source of information of government, what exactly is happening with the government finances, what does the budget look like, where can one seek additional information, or even if any queries are related to bond purchase or bond liquidity, all the queries could be directed now to DMO. And this, we believe, will help in removing the uncertainties and will make the investor view these bond issues in a very favorable term, and put together on an overall basis could ideally minimize the cost of debt issuance for the governments. So we believe this is a great institutional move by the GCC governments. However, not all is rosy. Despite the talks of vibrant debt market and the corporate market, establishment of institutions such as debt management offices, headwinds in the external form keep occurring, and act as a challenge for the debt market. One of the primary headwind is the increasing rates by the US Fed in the global monetary system. In 2017, we saw the benchmark interest rate climb to the range of 1.25% to 1.5%. In the recent January meeting, though the US Fed has left the rates unchanged, its outlook is still for 3 more rate hikes in 2018. So the increasing interest rates would act as a dampener for the bond issuance. It would ideally increase the cost of issuance, and it will also make the issues which are made earlier a bit less worthy. We can already see the change in the bond deals. Say for Saudi and Kuwait, wherein the bond spreads have tightened. In the case of Oman, Dubai, and Bahrain, the spreads have widened. For Oman and Bahrain, it's primarily a case of they being in below investment grade or in the junk territory, which has ideally led to the widening of the bond spreads. However, we believe, any change in the outlook for interest rate or any rapid acceleration in the rate hikes due to onset of inflation has the capacity to slow down the momentum which is happening in the bond market, and GCC governments would stand to be affected with them as well. Here we capture the credit rating change in 2017. As we can see, Qatar, which has been suffering from a diplomatic crisis with the neighbors, was downgraded because of changes in the trade routes for Qatar, and also Qatar had to dip a lot into their financial reserves to stop fund outflows in the monetary system, and to boost the economic activity and keep the infrastructure projects ticking. Qatar relied a lot on the international reserves, and with the dip in the reserves, most of the rating agency felt unless the diplomatic crisis is amicably solved within a short period of time, Qatar would continue to face some economic headwinds, and as a result of it, they downgraded Qatar by a notch. We also saw significant downgrades in Oman. Oman, which was at the start of the 2007 was an investment grade at triple B minus, was downgraded 2 notches to double B, and currently stands over there. Bahrain, which was already rated as junk, was further downgraded deep into the junk territory. We believe any risk to the ratings would currently stem from the lower oil prices, which looks unlikely at this moment due to better compliance with the OPEC deal. But we need to keep a constant watch of the compliance level by OPEC countries as well as non-OPEC countries in adhering to the production limits which they have imposed. And additionally, geopolitics is turning out to be a key factor which is continuing to influence the economies of GCC, which we saw in the case of Qatar. We need to keep a constant eye on that front too, for to ensure that the ratings remain same and is not unduly affected, which could further have an impact on the bonds and the cost of capital which they could rise. Looking ahead, 2017 seems to have been a bumper year for sovereign debt issuance in GCC, wherein more than $37 billion of capital were raised by the sovereign governments. Going ahead with the recovery of oil prices and consolidation of fiscal balances, we believe the value will steadily decrease. Though Saudi Arabia has said that they are kicking down the can for balancing the budget from 2021 to 2013. We see a lot of consolidation happening in a very steady manner. So we ideally foresee the issuances to come down. For 2018, we predict approximately 30 billion of capital to be raised by the sovereign government. This has been arrived by taking 40% of the deficits of the GCC governments in aggregate to be financed by international bonds. The rest would be financed by, utilizing the fiscal reserves, which are precisely created for this purpose of serving them in a rainy day, and through the local domestic issuances and maybe loans if at all they need to be. So in the next 5 years, if you see from 2018 to 2022, we foresee the GCC governments to raise approximately $70 billion of capital. However, the oil prices would continue to play a major role, and in case of the oil prices go lower below or break the $50 per barrel mark, then the issuances could again prop up. And again, the international climate would also need to be factored in regarding where do the intra-US Fed rates stand in, the current market environment, the attractiveness of the issues, the pricing at which they make. They will all go into influencing the sovereign debt issuances. Though we have talked a lot about the sovereign debt market and corporate debt market, GCC Sukuk market is something it's largely overlooked. Though people generally associate the Sukuk market with Saudi Arabia, Malaysia, or even the UK. Though Malaysia has been increasing its market steadily, not much of activity doesn't seem to happen in GCC Sukuk market. And many of proponents believe that with the fall of oil could provide a decent push for the GCC Sukuk market, but unfortunately that hasn't turned out to be true. GCC governments going ahead could take the initiative to issue sovereign Sukuk, though only Saudi Arabia has ideally tapped this instrument. In the coming years, maybe we could see it from some issuance from Kuwait, provided they change their debt management rules. In 2017, Saudi Arabia was more successful by raising USD 9 billion worth of Sukuk. And most of the Sukuk issues have been limited only to domestic investors. International investors have typically stayed away. Maybe that's one reason why GCC governments are not very active in making international issuance. Unless there is a huge demand, it wouldn't make sense for the people to go ahead with the issue. And one of the major reasons why investors have shied away from Sukuk is because of lack of standardized regulations or covenants in the Sukuk bond. And even the Dana Gas fiasco, wherein due to some change in the structures, the Dana Gas, the company which issued the Sukuk, backed away from it, stating that they won't honor the obligations, have ideally rattled the investors. Though it was an event that happened in the corporate Sukuk market, the ramifications are also felt in the GCC sovereign market. And unless we have a standardized convention or covenants and the regulatory body which ideally would oversee to ensure that there is, instead of 3 or 4 regulatory bodies, setting up a single regulatory body which could oversee all sorts of issues takes place. We don't see a rapid pickup in the GCC Sukuk market. And on the thoughts of concluding, we see the government's commitment to spending, the ability to narrow down fiscal deficits, and improving oil prices provide a decent outlook for further bond issuance in the international market by the GCC sovereign, as well as the corporates could make use of this opportunity to ideally pepper their market. But on the headwinds, the US interest hikes prove to be a significant barrier. And apart from that, there is a threat of rising inflation in the GCC markets with the introduction of VAT. And the geopolitical risk always, you never know when it's going to rise and decrease. Even that continues to influence the amount of bonds and the activity of investors, then their preferences for the issues towards this region. So with that, we come to the conclusion of this presentation. Questions, if any, could be asked out in the next 2 minutes. We will also be uploading the recording of the presentation in our Marmore website and YouTube channel. Alternatively, we'll also be mailing all the participants the presentation. You could, in case if due to any time constraint, if you feel that you can also send your questions to research@emarmore.com. We'd be more than happy to answer your questions. Thank you for attending the presentation on behalf of Marmore.